Good morning. Thank you for joining us for this event about the book, The Great Demographic Reversal, Aging Societies, Waning Inequality, and an Inflation Revival. We're so happy for you to be joining us today for this discussion about longer term economic trends and what those trends hold for the future. After 4 decades, is the world economy about to shift regimes? Economists Charles Goodhart and Manoj Pradhan argue yes in their new book. Globalization's forward march, the rise of China, and the breakup of the Soviet Union characterized a regime that began in the 1980s. During this period, the number of workers rose along with the ratio of workers to dependents. This led to a surge of global labor supply that depressed wages, led to higher profit shares, increased inequality within countries, decreased inequality between countries, led to a global savings glut, and put downward pressure on real interest rates. Dr. Goodhart and Dr. Pradhan argue that this is about to change and that a new era of high inflation and increasing interest rates will begin. And I'm so happy to welcome them here. Let me give a brief biography of each of our distinguished speakers. Charles Goodhart is Professor Emeritus of Banking and Finance with the Financial Markets Group at the London School of Economics, having previously been its Deputy Director. Until retirement in 2002, he had been the Norman Sosno Professor of Banking and Finance at LSE since 1985. Previously, he had worked at the Bank of England for 17 years as a monetary advisor, becoming a chief advisor in 1980. He was appointed an external member of the Bank of England's Monetary Policy Committee at the time of its founding in 1997. Manoj Pradhan is the founder of Talking Heads Macro, an independent macroeconomic research firm. He was previously managing director at Morgan Stanley and led the global economics team there. He joined Morgan Stanley in 2005 after serving on the faculty of the George Washington University and the State University of New York. He specializes in quantitative macroeconomics, emerging markets, and global economics. He holds a PhD in economics from the George Washington University and a master's in finance from London Business School. The run of show here will be very straightforward. We'll begin with a presentation on their book. Dr. Goodhart will begin, and then Dr. Pradhan will conclude the presentation. And following that, we will have a discussion. You are welcome to submit questions, and we hope that you do. Please submit your questions on Twitter using the hashtag AskAEIEcon. That's hashtag AskAEIEcon. You're also welcome to email your questions to Mariana Mitchell. You can find her email address on the event webpage. And with that, let me thank our distinguished panelists again for coming to talk about their book, and I'll turn it over to Dr. Goodhart.
Thank you very much indeed, Michael. You have summarized our book brilliantly, better than I could. So I'm actually going to start with a little bit of history. Can we have the first slide, please? What I'd like to remind everyone is that the last 70 years or so, since about 1950, have been really quite remarkable from a monetary and financial point of view. What you've got on the chart there are very long-dated interest rates, long-term yields on UK consols. And what you can see from that is that until about 1950, despite lots of wars, ups and downs, things that go bump in the night, the expectations of inflation, and with it long-term expectations of short-term interest rates, had remained relatively stable over the centuries since 1700 until 1950. Then from about 1950 until the end of the 1970s, beginning of 1980s, we had a consistent rise in inflation and in interest rates, both short-term and long-term. And that was followed by an equally dramatic, if not more dramatic, regular decline in inflation, inflation expectations, and interest rates, until inflation and interest rates are now lower in 2020 than they have ever been historically. Now, of course, the massive upturn in inflation and nominal interest rates, followed by the very equally remarkable downturn in inflation expectations and interest rates, are very largely due to the monetary regime. But the monetary regime is really just the proximate cause of this, in the sense that if somebody is killed by a bullet, the bullet is the proximate cause of death. But what is much more interesting is, why was the bullet shot at the person in the first place? And equally, the much more interesting question is, what were the underlying contexts that caused the politicians and the authorities to accept the rise in monetary growth that was consistent with the rise in inflation from 1950 to about 1980, and then the reversal. And no doubt, of course, the reversal from 1980 to the present owes a lot to the much improved monetary regime, the central bank independence, and an inflation target. Put very briefly, in my view, the proximate cause of the upturn from 1950 to 1980 was that those in charge in those years had been brought up and had their youth in the very depressed period of the 1930s, and were determined not to allow unemployment to rise again. And with the development of Keynesian analysis, allowing them to try to manage demand, what they did was to manage demand in such a way as to keep unemployment below the natural or non-accelerating rate of inflation. Then we had the turnaround after Paul Volcker and Ronald Reagan managed to defeat inflation in 80-82, a very difficult but an ultimately successful battle. But one of the points that I would want to make is that the defeat of inflation and the return to an inflation target was easier than had been expected, in the sense that it was consistent with continuous decline in nominal interest rates. So the underlying context in which the central bankers were operating an inflation target regime was relatively disinflationary. Indeed, after the great financial crisis in 2008, 2009, despite central banks throwing the kitchen sink in the terms of expansionary monetary policies, both normal in the sense of lowering interest rates and unconventional in the sense of QE and various other unconventional policies. Despite all that, they weren't able to bring inflation back to the target again. Although virtually any economist prior to about 2000 would have always said that central bank expansionary policies can always raise inflation, and yet that turned out not to be the case. So there was something else in the background between 1980 and 2020 that was bringing about a disinflationary context in which the central banks were operating. And it is our argument that what else was happening in the background was an enormous positive labor supply shock brought about by globalization and by demography. Let me turn to globalization first. On the left-hand diagram, the blue line was the amount of labor available for any businessman who could ship their production from one site to another over this particular period. You see it going up very slightly and then beginning to decline. But what occurred was that with globalization and the entry of China and Eastern Europe after the fall of the Iron Curtain into the world's global trading system, the amount of labor available for businessmen who could ship production from one place to another was now the blue line plus the yellow line. And the yellow line was also rising very sharply. Not only was there the baby boom in these countries, particularly in China, But also there was the migration from the internal Western areas to the more productive manufacturing Eastern areas. The dashed line represents Africa, which Manoj will talk about briefly. On the right-hand diagram, again, what you can see is the regular rise in the working age population over these years, rising steadily and very rapidly year by year until just after 2000. And it is now projected to decline equally sharply. And it's not only globalization, but also, of course, the demography, the dependency ratios, which you talked about, Michael, in your introduction. They've been very favorable to disinflation. One of the reasons, or three of the reasons why globalization leads to disinflation, the first one is that shifting production from high wage to low wage countries obviously means that the products coming out of the low wage countries are kept down in price and become relatively cheaper year after year. Second reason why globalization was disinflationary is that the ability to move production out of the high wage areas into the low wage areas gave managers, employers, bosses a credible threat to threaten that they might move production unless wages were restrained. And the shifting of mobile production, mostly manufacturing, out of the high wage countries into the low wage countries, also meant that there was a massive shift in the sectoral division of workers in their high wage advanced economies out of manufacturing into services. And in services, workers are less well organized and have much less bargaining power than they traditionally have had in manufacturing. The trades unions have been much stronger in the manufacturing sector than they were in the services sector, and trades union power has fell away dramatically over the years since 1980. Private sector trades unions are no longer the force that they were. As I said, this globalization effect has been reinforced by demography. Could we move on to the next slide, please? What occurred was that there was a baby boom virtually everywhere in the world after the Second World War, which meant that a very much larger number of workers were moving into the population, was moving into the working age population from, say, 1965 through 1970 and onwards, and are just now beginning to move out of the working age population. And the fall then in the number of the young after the baby boom was over and contraception became much more easily available. And there were other factors leading to a decline in the birth rate. What you can see is that the change between 1970 and 2010 in the proportion of young in the populations was really very large. Much larger during this period than the rise in the increase of the old. If you compare the change 1970 to 2010 of the young with the change 1970 2010 of the old, with the one exception of Japan, where there was a very considerable increase in the age, in the retirees, the old, relative to the number of young. Otherwise, in all the countries up to 2010, the dependency ratio declined really quite sharply. From 2010 onwards, it's really beginning to shift because the number of retirees is now beginning to grow quite sharply and will grow much more in future years, while there's been much less of a change as the birth rate, which is below the sustainable rate in most of our countries, has remained relatively constant, and the proportion of young in our economies has remained fairly stable. Moreover, the aged retirees take up much more resources, consume much more than the young do. The increase in the number of workers is disinflationary almost by definition. You don't hire a worker unless you expect the value of their production to be greater than the wage or salary that you pay them. Moreover, they have to save out of their income to pay for their continuing life cycle consumption when they retire. So that an increase in the proportion of workers is disinflationary, while an increase in the proportion of dependents, particularly the old, is inflationary, since they consume but don't produce. So it has to be inflationary. And as we can see from the next slide, the consumption of the old from 60 onwards actually increases relative to their earlier consumption because of the large cost of medicine, care, and pensions, which have to be paid to them. So the old are actually considerably more inflationary than the young, and there are going to be an increasing proportion of the old in our economies. And that the problem of an aging population is going to be greatly reinforced by the fact that medicine has been very successful at dealing with cancer and cardiovascular diseases, but has been totally unsuccessful at dealing with the neurodegenerative diseases such as dementia and Parkinson's, which affect predominantly the old, and it is very expensive to care for them, and it requires a lot of human help, empathetic help by carers to do that. And that is one of the reasons why deficits and debts have been increasing over time, well before COVID struck. Now, the globalization has had a really quite dramatic effect on what has been happening to equality and inequality in the world as a whole. Here, the left-hand column is, I think, one of the most dramatic that appears in our book. It's the ratio of the average wages of a worker in the US to the average ratio of a worker in China. In the year 2000, a US worker earned something like 35 times in real terms what a Chinese worker did. By the time you get to 2018, that ratio had fallen to 5 to 1. And that was a decline of a decline of 7 times 7, which is really absolutely dramatic and shows the impact of the stunning rise of China and the stunning increase in the share of world exports that they now produce. Same is true in the relationship between Western and Eastern Europe. They're not nearly so dramatic, shifting from about 4 in year 2000, so the French workers were earning 4 times Polish workers, down to just under 3 in 2018. And all that has meant that world inequality has actually been falling since about 2010, for the first time since about 1800. In 1800, everyone, all countries, were largely mired in agricultural subsistence. Then what occurred was that North America, Europe, Australia, and a few other places bounded ahead in terms of productivity and growth, while particularly populated Asia remained mired in subsistence. But over the last 25 to 30 years, that has changed dramatically. And that has actually meant that with Asia growing very rapidly, not only China, South Korea, Taiwan, Vietnam, Indonesia, Malaysia, Singapore, et cetera, there has been overall within the world a great increase in equality. However, the side effect of that has been that within the advanced economies, inequality has grown. Because if you're going to shift a very significant proportion of manufacturing production to Asia, to the low wage economies, what you're going to get is that the workers who previously did the relatively unskilled jobs, which could now be done by someone in China, in Vietnam, in Hungary, in the Czech Republic, that the relatively unskilled are going to have a terrible time. And indeed, the real wages of men and women in the lowest skills in the US, to a lesser extent, but even so in Europe as well, have pretty well stagnated over these last 30 years, even to some extent gone down. Whereas on the other hand, if you were skilled, if you had capital, human capital, if you had financial capital, if you had technological skills, the last 30 years or so in the advanced economies have been absolutely wonderful. It's been a wonderful 3 decades to have been a capitalist, but within the advanced economies, it's been a pretty lousy period to have been a relatively unskilled worker. The result of that has been that the workers who have lost economic power have hit back to an extent through the political system by tending to support rather more populist, anti-immigration, anti-globalization policies that we've had. Nevertheless, to go back to the problem of an aging population, what this now means is that there are structural forces arising from aging, arising from the worsening dependency ratio that we're now going to have, particularly with the increase in the old, which is going to increase deficits and debt in our economy quite considerably. And this was certainly the case well before the COVID pandemic struck. This figure shows the debt in the deficits in the purple line and the public sector debt in the yellow line in the UK from the Office of Budget Responsibility, or OBR, which is our equivalent of the Congressional Budget Office, or CBO, in the USA. And this shows that in the paper that they produced just before COVID struck, taking the data up to 2018, on present policies with present expenditure, present demographic forecasts, and so on, the deficits were going to get ever larger and the debt was going to grow almost exponentially. And the same was entirely true of the CBO. What has happened, of course, is that the pandemic has led to an upward step jump. And this is the latest CBO prediction. And in the upward exponential growth in the public sector debt was there before the pandemic, but the pandemic has given a sharp upwards rise to that. And I'm afraid that 2021 is likely to produce yet another sharp upwards rise in the debt and in the deficits that will be brought about, because the vaccines will not be rolled out quickly enough to stop the pandemic in its tracks much before the early summer. Now, what does all this effectively mean? So on to the next slide. Well, what's going to happen? How are we going to deal with the debt? The first point, an unhappy point, but one that has to be mentioned, is that it's very unlikely that growth will get us out of this, because growth is a combination of the increase in the working force interacting with the growth in the productivity of that working force. But the working force is now going to grow much slower. And indeed, in those countries which have grown fastest in recent decades, Germany and China, the workforce is actually now going to decline, as it has been declining in Japan for the last 10 to 15 years. As we move with the ending of well, not the ending, but decline in globalization, the retreat from globalization, the systemic conflict between the US and China, what is going to happen is that the offshoring of production and of capital out of the advanced economies into China and Eastern Europe is going to reverse to an extent. So I expect there to be more investment in our own economies, which will mean that productivity will rise. And as the labor force growth slows down or reverses, there was bound to be more pressure on productivity, because at the moment you can make massive profits if you can shift your production to a low-wage economy. In future, you're going to have to make profits by reducing unit labor costs domestically by increasing in capital and more efficient ways of doing things. Now, as I showed earlier, the increase in aging is going to have such an effect on our deficits that in order to stabilize, we're going to have much higher taxes and or somewhat lower expenditure. But increasing taxation and lower expenditure is politically poisonous, with the result that we expect that very few political systems will move sufficiently far to raise taxation and lower expenditures to an extent necessary to stabilize debt and reduce deficits to the necessary extent. As a result, we fear that inflation, although unattractive, may be necessary in order to bring about a reduction of debt, and will also keep real interest rates low because there will be political pressures to hold down short-term official interest rates at a time when the fragility of the private sector after the COVID crisis and the high debt ratios of the public sector are going to make it very, very difficult for central banks to raise interest rates at all quickly. Now, into this underlying structural occasion, what we've now got is the pandemic. And as you know, the monetary aggregates are now rising faster almost than they ever have in peacetime, and about 2 or 3 times at a rate greater than they did before. Meanwhile, many of the sectors which have been shut down or otherwise restricted have built up very large debt. And in order to pay off that debt, many of these companies are going to have to undertake higher markups. One of the features of the previous decade has been that markups have been declining, partly under the pressure of the tech industries and online purchases. But in future, in order to maintain solvency, we believe that higher markups are almost inevitable. So we think that inflation is coming. Now, in this, we are running against the analysis of the mainstream, which believes that inflation and interest rates will be lower for longer. I'm now going to turn over to my co-author, Manoj Pradhan, who will indicate some of the reasons why mainstream analysts do not accept our underlying argumentation.
Thank you very much, Charles, and thanks to the AEI for hosting us. We really appreciate it. So a few things I'm going to talk about and then conclude and then hand it over back to you, Michael. The first thing I wanted to talk about is the counter arguments that Charles and I have had over the last few years that we've developed this thesis. And there's 5 of them listed in here. I'm going to spend a little bit more time on Japan because it seems to be the one place where everyone uses as a blueprint for what aging should do to our societies and to economic and financial markets. The first one, Africa and India. It's a very popular numerical message that comes through. If you look at the demography in that part of the world, it's a very, very long time before their dependency ratios turn. In fact, one of their biggest problems is how do we get all these young people jobs? In other words, if you look at it numerically speaking, and you harken back to Charles's earlier chart, that dependency ratio and the availability of labor in Africa and India, some parts of Latin America, Indonesia, suggests that we really shouldn't be worried about demography from a global standpoint. However, there are 3 problems associated with this. Number one is that a huge chunk of the main contributors to the global economy and to global economic growth are the very ones who are going through this aging process. So Western economies, North Asia, and Eastern Europe are all going to show aging at a very, very, very significant rate. Number two, it's hardly feasible to think that the excess, if you will, of labor in these economies can be brought over to Western economies because the political climate simply doesn't allow it. And so what we have to depend on is to think that we'll shift capital over to these African and Asian and South American economies. They'll convert it into capital the way China did and bring it over. But again, keep in mind that what China had going for it was a very, very benign climate of significant consumption, of very rapid economic growth, which is not something that these economies have. And most importantly, where China can look back over centuries of exceptional workforce ethics and norms and guilds. Africa, for example, has a population the size of India, but 50 countries over which to coordinate policies. India itself has a significant amount of friction between the center and states, which makes a national policy like China's very difficult to achieve. And so we see problems in administrative capital that will keep these economies from transforming incoming physical capital into output at a pace which can offset aging in the rest of the world. I'll take the next three objections together. Why not limit the benefits to the old? Why not get the elderly to participate? And what about technology? I mean, that's been one of the mainstays of the argument here. First point to keep in mind is something that Charles alluded to earlier on, is that actually the UN population statistics that we get on aging are not frightening enough. That's because they do not attend to the number of people who will be required to look after the elderly. As this table is showing you, the older you get, moving from 65 to 75 into later cohorts, your ability to perform daily activities declines very sharply. So that if you're 85 plus, almost 80% of the people in that cohort will need some assistance. If it's not going to be family members who have to work or then sacrifice a part of the labor force, they will require more people to come in and look after them. We don't think it's robots. As Charles was saying, and he usually says very eloquently, robots have an emotional quotient of 0. What we need, and Charles and I know this from personal experience within our families, is we need empathy to look after the elderly. And so we depend on robotics destroying jobs in other parts of the economy. We need those low productivity, replicable tasks to be done away with. And we need that surplus labor that is released from those jobs to come look after the elderly. That's something that seems to be far more sustainable. Second is, well, it's very hard to, number one, reduce pension benefits. Many countries have had significant struggles. Russia is a case in point. Greece had riots when they raised the retirement age for a few years, and yet the gap between life expectancy and effective age of retirement has been growing linearly. What we're trying to show from this chart is that the trend of reducing pension benefits has elicited a participation response anyway. Just look at that green line over there, which is Germany. This is a very particular one that we wanted to point out. Before the Rurup Commission in 2003, Germany's participation rate in the pre-retirement cohort was in the mid-40s. Once the Rurup Commission introduced significant, credible, and government-backed policies to reduce the government's contribution to pensions, the participation rates went up to 65 to 70%. And so what we're trying to say is once you pass retirement, there's not that much juice that you can squeeze out of that rock. Participation rates in the advanced economies have already gone up, and we will need a significant amount of help. But this brings me to the final point of Japan. This is the most important pushback that we get, and we have dedicated an entire chapter. Some of the work that we've done in there, we're very proud of it because it's brand new to the debate, as is our contribution from chapter 4 on caring. And the main point that everyone takes away from Japan is when you've got an aging population, you will see low growth, low inflation, falling interest rates. However, keep in mind that Japan aged at a time when the rest of the world was swimming in labor and China was busy disinflating the entire world. What I'm trying to say is Japan had no way to stop the disinflation that China and the factors that Charles talked about at its borders. So like the rest of the world, it imported that disinflation. It imported that trend of falling interest rates. And indeed, if you look after that first lost decade of the asset price bust, Japan has not done badly. So if you look at the lower left-hand side chart, this is some of the original work we've done looking after 20 years of METI data, which is the Ministry of Finance for Economics and Trade. We poured over the reports, and we've gone in and actually come to the conclusion that Japanese corporates did not behave as if they were encumbered by deleveraging. Instead, they realized that the rest of the world was flush with labor. Labor was cheap in North Asia, and they increased their employment, their activities, and their investment in the rest of the world, particularly in China and North Asia, at an almost linear pace. So far from being crippled by Japan's demography, they actually took into account global demography in a profit maximizing way. And the other two charts are facts that are very well known about Japan. Number one is you can't really fire everyone in Japan. The labor market is just not flexible. So most of the adjustment came through hours worked. It came through moving people into part-time work. It came through moving people from manufacturing into services. And finally, actually, all those transformation made Japan far more productive. So while we look at Japan's growth rate very low at around 1% on average, their population was shrinking by 1%, and the gap between the 2% productivity growth is something that most economies would bite your hand off if you offered it to them. So the bottom line we want to provide here is that Japan happened in an era which was beset by disinflation and falling interest rates. That is not the environment we are in right now. So using Japan as a blueprint for demography to lead to disinflation gives you incredibly incorrect inferences, and we would caution aggressively against that. And finally, to conclude, as Charles said, inflation is coming. We've had debt before. We've had central banks push monetary aggregates higher before. What's different this time? Well, first, foremost, demography is turning. But within that, the cyclical backdrop is also different. In the great financial crisis, you had money that was injected into financial institutions that were very determined to keep their balance sheets intact, and thus they could put money in financial assets. That was a fungible investment for them as far as bonds lending was concerned. Today, fiscal injections have been given to households and companies whose maximization objective function is either utility, profit maximization, market share, and they are far more likely to spend that money. There's no doubt that all of you have been subject to commentary about the exceptionally high savings rate in the advanced economies. Well, think about why they have that savings. They have the savings for the same reason that the velocity of money has plummeted. We are not going anywhere out of our houses. We're stuck inside. But if the savings rate is going to fall, velocity is going to rise with very high monetary aggregates. So the yield curve is going to steepen. Central banks are in no position to start pulling out monetary tightening by raising policy rates. And that means they will allow yield curves to steepen, but even then to an extent. And if yield curve control is deployed as it was in Japan, that will keep nominal interest rates down while inflation is rising, which will only act as a pro-cyclical boost. That will make asset returns much harder to extract. It will lower within a country inequality that Charles had talked about before. But perhaps one of the most interesting and fascinating debates, particularly given Charles's experience in central banking, is that central bank independence will come under threat. In the last 30 or 35 years, why would any administration stand in the way of central bank independence if they were lowering interest rates, raising asset prices, and allowing houses to be bought? That's all great news. But if central banks are now inclined to try and fight inflation, they will go against the wishes and against the political desires of the incumbent parties, and that will bring upon an increasing conflict. But that's it from us. I'll stop our presentation here and turn it back over to you, Michael. Thank you very much.
Thank you both. I think everybody in the audience is able to see from your presentations how thoughtful the book is. It's one of those rare books where the deeper I read into it, the better I thought it was, and the more compelling I thought it was. And so it really was just a joy to read, and it'll be something that I'll be thinking about for years and years and years. And so I encourage everybody in the audience to buy copies and to really give this argument some thought, because it does run so counter to what we're hearing. And I think the authors make such a compelling case for their thesis. Let me let me begin by, I guess, by quoting the great American philosopher Yogi Berra, who said that predictions are difficult, especially about the future. I think that if you had gone back in time to the 1970s or 1980s and had told economists that China was going to follow an economic model that was really imbalanced heavily toward investment, and that they were going to draw capital from around the world. Even if you also told those economists that the Chinese workers would enter global labor markets, the expectation, I think, would have been that real interest rates would increase. If you go back in time to the year 2008, there was a widespread expectation that the extraordinary measures taken by the US Federal Reserve and by other central banks to support the economy following the financial crisis would lead to above trend inflation. Claims of hyperinflation, I think, were exaggerated, but above trend, I think, was a common expectation to be held. Of course, as you say in the book, central banks have failed even to hit trend, even to hit their inflation target. If you go back in time to March of 2020, the combination of supply chain disruptions and another round of extraordinary measures by the central bank led many economists, even those who had learned the lessons from inflation's response to 2008, to be concerned about the possibility of inflation again. What this suggests to me is that economists don't really understand inflation. That the behavior of prices on a macroeconomic level is in some fundamental way mysterious. And you address this in your book when you discuss the debate about the role of inflation expectations in actual realized inflation. You note that there are some economists who believe that expectations are the entire determinant of inflation, other economists who believe that they really play a more minor role. I wonder if you could just reflect on this kind of general observation that that some of the variables that you are discussing, perhaps especially inflation and interest rates, just aren't well understood by economists, and how that affects your analysis. And that can go to either of you.
Well, I think you're right. And one of the points that we're trying to make is that macroeconomists are really almost entirely focused on the next 2 years. The horizon is really quite short. And if you take a 2-year horizon, the trends that we're talking about, demography and globalization, really don't enter into it at all, except in some extreme cases. You may say that the turnaround in globalization, with the shift in the policy towards China in the US, is one of the factors that economists have taken into account. But the underlying context of demography and the impact of globalization has really not been taken into account by economists at all. One of the issues that I would say is that the collapse in the monetary base multiplier that occurred in 2008, 2009 was connected in some large part to the payment of interest on excess reserves. And I think that policy was always dubious and is now actually counterproductive. George Selgin wrote a very good book on this called Flawed, which F-L-O-O-R-D, not F-L-A-W-D, but I think he meant the synonym to be there as well. And I don't think that that people really appreciated that the payment of interest on excess reserves would have the effect that the huge increase in the monetary base wouldn't spill over in the context that Manoj very clearly showed, where the financial system and the banks were focusing on solvency, and there wasn't a great demand for loans from the private sector anyhow. But yes, our book is in some part an argument that the horizon and approach that macroeconomists are undertaking has been insufficient in the case of inflation, and in terms of the determinants of interest rates. You need a much longer historical background, I think, in order to understand or to begin to understand what may be going on.
Actually, Michael, to add one small thing to what Charles said, I completely agree with what both of you say. The really interesting thing about a lot of the presentations that we have done, and we've been doing them for a while now, is that the early part of the discussion, where Charles was delving very deliberately and very nicely about the disinflationary impacts that we've seen over the last 30 or 35 years, most people are very happy to attach demography and disinflation to each other. That's absolutely fine for them. Yet surprisingly, when we talk about the reversal of demography, which no one questions because the statistics are very clear, there is a wedge that most people drive between that change in demography and inflation. And in reality, if this was a scientific laboratory, the onus of showing why the breakdown in that relationship happens would be upon them, not upon us. But it turns out that we're in a world where the financial markets or the experience of the last 30 years has been so heavily embedded that it's very difficult for people to just make that step change. Once it happens, I think they'll move on to that trend very quickly. But it's at that turning point which we are at, which is not only a cyclical and structural, that it's hard to make that turnaround.
Yeah, I think that's thoughtful. Let me commit the sin of economists that you're pointing to and make a point about the next year. I think Charles, your observations about the behavior of the money supply, I think are very important. If you just look in the United States at a simple chart of M2, what you see is that M2's reaction during the financial crisis of 2008 was quite muted. If you look at M2 during the pandemic, there's a significant and sharp upward spike, and that's one of the things that makes me think that at least over the next year, the risk of inflation is significantly greater than many believe. Let me actually build on that and ask, why is it that you think that markets don't agree with you? I think it's easy to explain why economists might not, because there are competing theories about how the global economy works. The last time I checked, investors, judged by the 5-year forward, 5-year real indexed bond rate, are expecting that rate to be negative. 10-year forward expectations of the 10-year real interest rate, the last time I looked, were also expected to be negative. So these are over, these statistics don't suffer from the 1 to 2 year bias that I think both of you are really correctly pointing out, and they also don't necessarily suffer from the kind of usual academic debate factors. These are expectations that are based upon the behavior of actual investors and actual markets. What do you say to that critique?
Well, let me start, because I know Manoj will add, and rightly so. I just make 2 points. First one is don't fight the Fed remains a very important motto for anyone in the financial system. The other thing that I would say, again, it's about horizons. People tend to overweight the present enormously. So if inflation has been low over your career as an analyst or a trader, And most of the analysts and traders are pretty young, anyway, by my standards. So they've only known really low inflation. The Fed and a lot of the economists told them that this would continue to be low. Why should they differ?
Oh, Manoj, I think you're on mute.
I'll add a few small things here. First, I mean, the thing that Charles was talking to, there's very little work done on that, but there is one paper called The Excess Sensitivity Puzzle, I think back in 2002 or 2003 by Goodhart, Sack, and Swanson. And they argued that five-year forwards show an excessively high correlation to 1 year or 2 year movements, that they really should not. If you look at the survey of professional forecasters, the 10-year ahead SPF number never changes. It's the 1 year number that changes almost entirely. But financial markets don't behave like that. Part of the reason is that you do tend to see a lot of gamma movements and delta hedging and that kind of stuff, but that's really technical. If we get down to absolute brass tacks, the information that's coming out today out of financial markets has to be handled carefully for two reasons. Number one, go back to the 80s and the 90s. At that point in time, five-year forwards, 10-year forwards, 20-year, 10-year, they were all showing you the same information that inflation would be 8 to 9% for the next 20 or 30 years, and that was completely wrong. So again, going back to that initial point about structural turning points, if there is a number that doesn't change over a 2-year forecast model from a normal economist, it won't be captured. Second thing is, if you look at the break-even curve today, the break-even curve today is higher everywhere above the nominal curve. And that is partly because participants believe that the Fed probably has more protection in its future than tightening, which means with interest rates at zero, if it wants to allow the fiscal policy measures to finance themselves at a cheap enough rate, it may have to come up with yield curve control. And if that's the case, markets will be compensated for one or two things. They'll be compensated for inflation or for growth. And right now they're saying inflation is the bigger worry at this point in time. So I'm going to push break-even inflation higher, and that pushes real yields down. So that may be a construct which, as Charles said, the market is simply not fighting the Fed. Overall, though, I think it is this is the failures of the last decade, despite having similar kind of policy measures which have not resurrected inflation, that I think markets are hanging on to.
So let me ask you about the turning point that you mentioned. The thesis you're putting forward is that we're kind of at the turning point, and that we should expect to start to see the effects of that turning point reasonably soon. Could you make an argument that the turning point really began 20 years ago? That if you look at workforce participation, that started to level off and actually started to decline in some countries around the turn of the century. That if you look at globalization, at least by some measures, globalization has been in decline for over a decade. And if the turning point began that long ago, why has it been so difficult for central banks to hit their inflation targets, and why have we continued to see declines in real yields?
Well, there's an enormous amount of momentum in the system, and one of the arguments that we're making is that these trends really trashed labor bargaining power and reduced the power of trade unions. And labor bargaining power and the power of trade unions remains really very low. If it hadn't been for COVID, when we started working on this, we were very uncertain when the shift in these trends would actually lead to a change in the underlying dynamics of wages and inflation. And we really were not able to place it to within plus or minus 5 years. It could be as far ahead as 2030. We do believe, however, that the policy response to COVID, past and likely future, I'm not saying that the policy response was wrong. It's not our point. We're not arguing that it was wrong to throw money at people who otherwise wouldn't have jobs, or that it was wrong to throw money to companies that otherwise would have gone down. But what we are saying is when we come out of this, when the vaccines do defeat COVID, then there will be a hell of a lot of money around, hell of a lot of savings around, and it will lead to at any rate temporary blip in inflation, which could well, because the trends have now reversed, continue. So the problem with our thesis prior to COVID, and even to some extent after COVID, has been timing. People accept, I think, our trends, but they do, and in a sense, I think we're right prior to COVID to ask, well, what about the timing of all of this?
I think the one comment after COVID we get aggressively is the concept of scarring, right? That these labor markets are not going to improve very quickly, and things will take a lot longer. And that's perhaps the only new argument. Earlier, it used to be debt. Now it's the concept of scarring in labor markets. But we've argued that a lot of the factors that we discuss are strong enough to overwhelm a part of that story, particularly as those incredibly high savings rates come down. Those have come from upper and higher income households. And those are likely to push growth a lot faster while there's been a supply shortage.
Yeah, I've been struck here in the United States at how limited the evidence is for the type of scarring that you're referring to. It's really been one of the biggest surprises, I think, of the last 6 months has been how contained the damage seems to be, and how poised the United States is to kind of spring back once there's a vaccine. I credit both fiscal and monetary policy for that, but also the nature of the recession. There was no inherent imbalance going into March, and so there's nothing to kind of unwind. Let me ask a question about wages. You, in the book, point to a central role for bargaining power, argue that the massive global labor supply shock has inevitably reduced the bargaining power of workers. And I think that's right as far as it goes. Another argument you could make in addition to that, of course, is that bargaining power was reduced because in the developed economies, quasi rents were reduced as a consequence of increased competition and the recovery of Europe from the Second World War. I wonder, what role you think that plays, and then in addition to that, bargaining power, of course, affects wages, affects real wages even. But the primary determinant of real wages, at least in my view, is productivity. And how do you think that those two factors, there's just less for labor and management to bargain over because the world is more competitive than it was in the 1960s, and that productivity really will be what drives real wages over the longer term. How do those observations? Maybe you don't agree with them, which is fine. But how do those observations affect your conclusions and your analysis?
Well, I think that you must be right. And productivity is the ultimate driving force, and the driving force behind real wages. And our view is that over the last 30 years, the availability of this massive surplus of labor in China and elsewhere has meant that it's been really very easy for a large proportion of employers to gain very large profits, effectively by shifting production offshore. And that has meant that they haven't been under anything like as much pressure to increase productivity at home by increasing efficiency and undertaking investment domestically. As globalization retreats, we tend to think that productivity will actually recover. We think that in future, the investment ratio in our countries and the productivity in our countries will rise again from the very depressingly low level it's been at for about the last 20 or so years. So to that extent, we are in a way optimists. But the problem that we see is that the offsetting decline in the working age population, or rate of growth of the working age population, is so big that it would require a massive increase in productivity to more than offset it. So yes, there will be an increase in productivity, and that is one of the reasons why the real wages and of course the nominal wages of workers in the US and in other countries will rise in future by much more than they have over the last 30 years. And it is a productivity story, which we buy into.
So, Michael, one small thing to add. Let's break this labor market into two parts, right? Let's break it into a part which is at the upper end of income and productivity, which finds more capital, which replaces lower productivity labor as a complement, and hence sees jobs and incomes protected. And there is a lower part of that population of the labor force, which is lower in productivity and earning lower income, which finds that increased technological innovation might be a substitute. And hence suffers, as Charles has shown you in there. Emerging markets play a very similar role to technology. Now, when we all did Trade 101, we all did Stoper-Samuelson, which is that, a shock to one part of the labor market, one sector in the labor market can raise wages in that sector. And if it's a large enough, a pervasive enough shock, and there is free mobility of labor, then it raises aggregate wages. And there's something like this going on here, which is that a large part of that released labor force at the lower end is the part that will be required to look after the elderly. If you're right about chapter 4 and the coming crisis in caring, then the services sector, particularly looking after the elderly in some shape or form, will be able to protect wage growth for those who find technology a substitute rather than a complement. So you're protected at the upper level with a productivity complement story, as you and Charles were describing. But even at the lower end, I think wages seem to be protected because of the process of aging. So I think it's not just necessarily a relative story. I think it builds into an aggregate one as well.
Let me ask one more question. I know we're 2 minutes over time, so let me ask a final question that comes from our audience. Which is what role do you think investors' expectations about risk will play in interest rates going forward? If we continue to see a massive increase in deficits and in debt, do you think that investors' expectations about default will they start to get a little skittish? Will that put upward pressure on rates? How does that play into your analysis?
It's a particularly European problem because either way, if the ECB tightens sufficiently to hold inflation down, then it's likely that there will be recessions in the weaker countries in Europe, and that will raise the concern about default in those countries. And if there isn't a sufficient tightening of the ECB, even so, the likely pressures on the weaker countries in Europe may lead to greater risk there. I think the problem of default in countries like the US and the UK, public sector default, is pretty unlikely unless policies get things very wrong. When you've got your own central bank, you can always pay off the interest and the debt if necessary through inflation. And as we argue, we believe that there will, in a sense, be more default, because that will be default via unexpected inflation that we believe will come around.
I mean, I think over the next 2 years, the cheerleading squad for inflation is going to dominate, right? For the first, if you look at Cleveland Chair's Mester's comments yesterday, 2.5% inflation is going to be fine. When we hit that 2.5%, the Fed is going to declare victory. Markets will be very happy because, yes, it reduces the real burden of debt, which has been a serious problem thus far. The problem, I think, a real issue arises if we're right and that inflation persists over the next year, the year after that, and the year after that. And then the question comes about is, what are you prepared to do if inflation is persistent, higher than you expected, and we really have to do something about it? So in the next year or two, I think this will all sound like a really good story. It will be accepted by both policymakers and financial markets as a triumph, really. And the problems really arise after that, not right now.
Yeah, I agree with that. I think 2.5 or even 3% inflation will be viewed as a policy victory, and not as something to be concerned about. At least that's how I will view it. And I'll conclude there. Let me again just recommend to the audience this book. One of the things that I admired the most about the book was the author's engagement with counter arguments, the author's engagement with other theories that at first glance don't seem to support their view. The authors have entire chapters in the book where they say, here's a counter argument, here's why we don't agree with it, and I think that really adds to the strength of their case. So I recommend the book is in the highest possible terms, and I'm so grateful for Dr. Goodhart and for Dr. Pradhan for joining us today. Thank you all in the audience for joining as well. Thanks for your questions, and thanks to those who will watch the video at their convenience at a later date. Thanks, everyone.
Thanks for having us.